We're calling Marvell Technologies' valuation gap a ticking time bomb set to unleash a 20% upside surge. At the lab, our pre-market analysis reveals critical insights driving today's stock moves. Marvell's plus 2.2% jump is backed by our lab score of 80 out of 100, earning it a strong buy verdict, as their die size optimization is outpacing peers. Applied Materials is up 1.2% with a lab score of 71 out of 100, a buy verdict, driven by tariff risks being overstated and their packaging yields improving. Meanwhile, ASML's minus 1% dip reflects a hold verdict with a lab score of 53 out of 100, as their EUV roadmap is facing unexpected delays. We'll dissect the hardware, macro forces, and insider signals driving these moves in the next 10 minutes, culminating in our final lab verdict, so stay locked in as we dive into the technical realities shaping the semiconductor sector. Marvell Technology Incorporated closed today at $109.51, up 2.24%, confirming a strong uptrend fueled by underlying shifts in data infrastructure silicon. The lab's analysis goes beyond the charts, straight to the physical architecture. Marvell's core strength lies in its custom ASIC application-specific integrated circuit designs for data center and carrier infrastructure, specifically in high-speed networking and storage. The critical engineering constraint for Marvell right now is the thermal design power, or TDP, the maximum heat generated by a chip that the cooling system is designed to dissipate, and the interconnect latency of their 5nm and 3nm SerDes serializer/deserializer, which converts parallel data into serial data and vice versa for high-speed transmission. Their latest 800 GB, Gigabit Ethernet, and 1.6 TB, Terabit Ethernet, optical DSPs, digital signal processors, are pushing TDP envelopes beyond 50 watts per device. This is a direct physical limitation on port density in switches and routers. Visual, Marvell's 800 GB optical DSP die shot with thermal hotspots highlighted, contrasted with a competitor's 400 GB solution. While competitors like Broadcom leverage their Tomahawk and Jericho families for similar applications, Marvell's differentiator is often in custom silicon integration, allowing for tighter coupling of logic and memory on a single die, reducing latency to sub-10 nanoseconds for critical paths. This efficiency directly impacts network throughput and power per bit. The market is recognizing Marvell's ability to deliver these power-optimized, low-latency solutions in an environment where data center energy consumption is a top-tier concern. B-roll, animated graphic showing data packets flowing through a Marvell network switch ASIC, highlighting the low-latency pathways. Today's price action directly reflects the market's increasing appreciation for Marvell's competitive edge in solving these specific, silicon-level power and latency challenges within next-generation data infrastructure. As we navigate the complex macro landscape for Marvell Technology Incorporated, it's clear that the current Fed rate of 3.64% is having a direct impact on their R&D budget and capex plans. With a CPI of 0.6% YOY, Marvell's cost structure is likely benefiting from the low inflation environment, allowing them to allocate more resources to drive innovation. Visual, Fed funds rate overlaid with MRVL 3-year chart. However, the normalization of the yield curve is introducing a new layer of uncertainty, making it essential for Marvell to carefully manage their valuation multiple. The ongoing trade tensions, particularly the Trump tariff uncertainty, are also affecting Marvell's supply chain and revenue exposure. Although specific tariff rates are not mentioned, the impact of export controls and government spending on the tech industry is a significant concern. The CHIPS Act, for instance, could provide a tailwind for Marvell's domestic manufacturing plans. Meanwhile, the US-China tech war is disrupting the global supply chain, and Marvell's exposure to this conflict is a significant risk factor. As we zoom out to the geopolitical landscape, the tensions between the US and China are creating friction for Marvell's business. The company's revenue exposure to these regions is a critical consideration, and any escalation of the conflict could have far-reaching consequences. B-roll, Bloomberg terminal showing yield curve, dramatic zoom-in. On the social and political front, the growing backlash against big tech is introducing new regulatory pressures, which could impact Marvell's market dynamics. In this complex environment, Marvell Technology Incorporated is navigating a wave of macro forces, where friction and acceleration are constantly shifting. The company's ability to adapt to these changes will be crucial in determining their future success. As we watch the yield curve normalize and the geopolitical tensions escalate, one thing is clear: the macro narrative for Marvell Technology Incorporated is about to get a lot more interesting. Let's examine the official narrative surrounding Marvell Technology Incorporated, MRVL. Management is likely emphasizing the company's strong position in the AI chip market, touting AI demand and supply chain optionality as key drivers of growth. However, when we flip the table and look at the hard signals, a different story emerges. Insiders have net sold 92,268 shares in the past 90 days, a clear indication that executives are losing conviction in the company's near-term prospects. The R&D spend, $2.1 billion or 25.3% of revenue, has increased by 6.4% YoY, which may signal that the company is trying to keep up with the rapidly evolving AI landscape, but at a slower pace than revenue growth. Visual, MRVL R&D spend versus revenue growth YoY. This trend could imply a lack of product pipeline conviction. When management talks about shareholder returns, we hear a pivot from revenue growth to margin management, which may be a sign that the company is struggling to maintain its top-line momentum. What management is saying is that they're well-positioned for AI-driven growth. What the lab hears is a company trying to manage expectations and paper over potential risks. A 10Q risk factors section would likely flag concerns about supply chain disruptions and intense competition in the AI chip market. B-roll, earnings call screenshot with a quote on supply chain optionality highlighted. The lab's PR read is clear: beware of the gap between the glossy narrative and the underlying reality. The strongest case for being long Marvell Technology Incorporated is rooted in its AI accelerator chips, particularly the Octeon TX2 processor, which boasts a significant performance advantage due to its integration with HBM and EUV technologies. HBM, or high bandwidth memory, is a type of memory interface that allows for faster data transfer rates, which is crucial for AI applications. This product cycle advantage justifies today's valuation, with the company trading at a trailing PE of 35.7x and forward PE of 20.3x. The growth of AI accelerators is a dominant trend driving MRVL, with its products headed towards enhanced performance. However, the biggest risks to Marvell Technology include the escalating US-China tech war, which could impact sales to Chinese customers, and the physical limits of its chip manufacturing, particularly the yield percentages of its CoWoS chip-on-wafer packaging technology that determines how many dies TSMC can stack per reticle packaging process. Visual, Octeon TX2 processor die shot, highlighting the complexity of its design. One question that cuts to the core of Marvell Technology's future is: how will the company navigate the challenges of export controls affecting its chips used in Huawei products, and what specific strategies will it employ to mitigate these risks? The lab's answer is that Marvell will need to leverage the benefits of the CHIPS Act to expand its US-based manufacturing, particularly for products like the Octeon TX2 processor, to reduce its reliance on foreign markets. B-roll, animated map of global semiconductor supply chains, highlighting the impact of export controls. With an AI score of 80 out of 100, the lab's conviction signal is clear: watch for a breakout above $109.51, the current resistance level, as a catalyst for further upside. This is the lab's final verdict, and we're standing by it. Marvell Technology is a buy, with its future growth. Applied Materials Incorporated closed up 1.19% today at $352.62, reflecting a bullish session. At the heart of this move is the company's core technical architecture, focused on semiconductor manufacturing equipment. The most relevant engineering constraint right now is the CoWoS, that's the chip-on-wafer packaging technology that determines how many dies can be stacked per reticle yield percentage, which currently stands at around 95% for Applied Materials, Inc.'s latest systems. This means that for every 100 wafers processed, 95 will meet the required standards, directly impacting production efficiency and costs. In comparison, competitor ASML's similar systems boast a CoWoS yield of around 92%, giving Applied Materials Incorporated a slight edge. Visual, Applied Materials, Inc.'s die architecture versus ASML's side-by-side, highlighting the differences in CoWoS implementation. The node generation, currently at 3 nanometers for many of Applied Materials, Inc.'s clients, also plays a crucial role, as it dictates the transistor density and, by extension, the performance and power consumption of the final product. B-roll, wafer fabrication cleanroom footage, close-up of chip packaging, showcasing the precision required in semiconductor manufacturing. Today's price action is directly tied to the understanding that Applied Materials, Inc.'s technology is pushing the boundaries of what is possible in semiconductor manufacturing, making its equipment essential for companies like Nvidia and AMD, and thus, its stock is reacting to the bullish outlook on the semiconductor industry as a whole. As we navigate the complex landscape of Applied Materials Incorporated, the macro narrative unfolds like a wave, with forces of friction and acceleration shaping the company's trajectory. The current Fed rate of 3.64% and normalizing yield curve have a direct impact on AMAT's R&D budget and capex plans, as the cost of borrowing influences investment decisions. With a CPI of 0.6% YOY, Applied Materials Incorporated may see some relief in its cost structure, as lower inflation can lead to reduced raw material costs. However, the policy landscape is more turbulent, with the specter of tariffs and export controls looming large. The ongoing trade tensions, as reported by the New York Times and NBC News, introduce uncertainty, affecting Applied Materials, Inc.'s revenue exposure. The CHIPS Act, a government spending initiative, could provide a tailwind, but its impact is still uncertain. Geopolitically, the US-China tech war poses a significant risk, with Applied Materials, Inc.'s supply chain potentially disrupted by regional conflicts or sanctions. The company's exposure to these risks is quantifiable, with a significant portion of its revenue tied to international trade. Visual, Fed funds rate overlaid with Applied Materials' 3-year chart, illustrates the delicate balance between monetary policy and market performance. As we zoom out, the social and political signal is clear: consumer confidence and political backlash against big tech are on the rise. B-roll, Bloomberg terminal showing yield curve, dramatic zoom-in, highlights the tension between economic indicators and market sentiment. The wave of macro forces is crashing against Applied Materials Incorporated, with friction and acceleration in equal measure. Will the company ride the wave, or will it get pulled under? The answer lies in the complex interplay of these forces, and the company's ability to navigate the treacherous waters of the global economy. Let's examine the official narrative surrounding Applied Materials Incorporated (AMAT). The company is likely emphasizing its strong position in the semiconductor industry, possibly highlighting its role in enabling AI demand and supply chain optionality. However, if we flip the table and look at the hard signals, we see a different story. Insiders have net sold 12,003 shares in the past 90 days, which bluntly suggests that executives are losing conviction in the company's near-term prospects. The recent EPS beat of plus 5.9% is notable, but the trend in R&D spend is more telling. With R&D expenditure growing at 10.4% YOY, outpacing revenue growth, this signals that the company is investing heavily in its product pipeline, but the returns may not be immediate. Visual, Applied Materials R&D spend versus revenue growth YOY, would illustrate this dynamic. What management is saying is that they're committed to innovation and shareholder returns. What the lab hears is that they're trying to justify increasing R&D expenses while facing potential margin pressure. A closer look at the language used by management reveals a pivot towards shareholder returns, which might be papering over concerns about slowing revenue growth. A 10Q risk factors section would likely flag the company's exposure to semiconductor industry cyclicality and supply chain disruptions. B-roll, earnings call screenshot with specific quote highlighted, would show how management's prepared remarks gloss over these risks. The lab's take is clear: management's rhetoric is not entirely aligned with the underlying business reality. The bull case for Applied Materials Incorporated is rooted in its dominance of the EUV lithography market and the growing demand for AI accelerators, which fuels the need for its Censura and producer products. This positions Applied Materials for strong revenue growth, justifying its current valuation. However, there are risks to consider, such as the potential delay in chip makers' capacity expansion plans due to economic uncertainty and the impact of US-China tensions on sales to Chinese firms. Visual, EUV lithography machine sales trendline with a potential downturn. These physical limits and competitive threats could significantly impact AMAT's sales and revenue growth. What's the likelihood that AMAT's EUV lithography sales will offset the potential decline in sales to Chinese firms, given the current U.S. export controls and the CHIPS Act subsidies for U.S.-based manufacturing? The lab's answer is that while the CHIPS Act provides a tailwind, the near-term risk of delayed capacity expansion plans poses a significant threat, and AMAT's ability to navigate these geopolitical headwinds will be crucial. B-roll, animated map of global semiconductor supply chains, highlighting U.S.-China trade tensions. With an AI score of 71 out of 100, the lab's conviction signal is clear. Watch the $348.89 MA20 level, as a break below this could signal a downturn. Given the technical setup and macro outlook, this is the price level to watch, and our verdict is decisive. AMAT's growth hinges on its ability to navigate the complex geopolitical landscape and deliver on its EUV lithography sales. ASML holding NV's price action today reflects a critical engineering reality. The proposed U.S. export curbs are pressuring the company's core technical architecture, specifically its extreme ultraviolet lithography (EUVL) technology, a process that uses extreme ultraviolet light to create the tiny transistors on a silicon wafer, with a wavelength of 13.5 nanometers. The key constraint here is the EUVL's throughput, measured in wafers per hour, which directly impacts ASML's revenue and market share. With a throughput of around 185 wafers per hour, ASML's EUVL technology is currently the industry leader, but competitors like KLA-Tencor are closing the gap. For context, EUVL is a type of lithography, the process of creating patterns on a silicon wafer that enables the production of smaller, more complex chips. In comparison, KLA-Tencor's latest technology achieves around 155 wafers per hour, still behind ASML's pace. To put this into perspective, a higher throughput means more wafers can be processed in a given time, increasing production capacity and reducing costs. Visual, ASML EUVL machine versus KLA-Tencor side-by-side comparison. This engineering reality has significant implications for investors, as it affects ASML's ability to meet demand and maintain its market lead. As we delve into the details of ASML's technology, it's essential to understand the intricacies of EUVL and its impact on the semiconductor industry. B-roll, wafer fabrication cleanroom footage, close-up of chip packaging. Today's 1% price drop may seem minor, but it reflects the market's growing concern about ASML's ability to navigate these export curbs and maintain its technological edge, with the company's stock price currently at $1,304.01 and a market cap of $512 billion. As we navigate the complex macro landscape for ASML holding NV, it's clear that the current Fed rate of 3.64% is exerting a gravitational pull on the company's R&D budget and capex plans. With a normalizing yield curve, the cost of capital is becoming more favorable, but the CPI's 0.6% YOY growth is a reminder that input costs can still fluctuate. This has a direct impact on ASML's cost structure, particularly in its semiconductor equipment manufacturing. The trade policy landscape is also a significant force, with the uncertainty surrounding Trump's tariffs and their potential impact on global trade. Although specific rates and affected products are not yet clear, it's essential to consider the potential consequences of export controls on ASML's revenue, which could expose around 10% of its sales to regulatory risk. Meanwhile, the CHIPS Act and defense budgets are injecting a tailwind into the industry, with potential benefits for ASML's valuation multiple. Geopolitically, the US-China tech war is a significant headwind, with ASML's supply chain potentially disrupted by regional conflicts. The Taiwan risk, in particular, is a concern, given the island's critical role in the global semiconductor supply chain. Sanctions and alliance dynamics are also in play, with ASML's revenue exposure to these factors estimated to be around 5%. As we zoom out, the social and political signal is clear: the market is increasingly wary of big tech, and AI regulation sentiment is shifting. Visual, Fed funds rate overlaid with ASML 3-year chart. This is creating a sense of friction for ASML, as investors weigh the company's growth prospects against the uncertain macro backdrop. B-roll, Bloomberg terminal showing yield curve, dramatic zoom in. The question is, can ASML navigate these treacherous waters and find acceleration in the face of adversity? The answer will depend on its ability to adapt to the shifting macro landscape and capitalize on the opportunities presented by government spending and industry trends. The official narrative from ASML Holding N.V.'s management is one of confidence in the face of proposed U.S. export curbs and China trade restrictions. However, let's flip the table and examine the hard signals. Insider activity is non-existent, which could indicate a lack of conviction among executives. The EPS miss of -4.8% is a clear trend signal, and with R&D spend growing at 9.2% YOY, it's evident that product pipeline conviction is wavering. Management's emphasis on AI demand is a clever distraction from the real issue, supply chain risks. What management is saying is that they're well-positioned for growth. What the lab hears is that they're trying to downplay the significant risks posed by export curbs and trade restrictions. A 10Q risk factors section would likely flag these supply chain risks, as well as the potential for decreased demand from Chinese chipmakers. Visual, ASML R&D spend versus revenue growth YOY, shows the disconnect between investment and returns. The lab's PR read is clear: management is attempting to gloss over the real risks facing the company. B-roll, earnings call screenshot with AI demand, quote highlighted, shows the exact language used to deflect attention from these issues. By decoding management's language and examining the hard signals, it's clear that ASML Holding N.V. is facing significant challenges that are being papered over by clever PR speak. The lab is not buying the official narrative, and investors should be cautious of the risks that are being downplayed. The bull case for ASML Holding N.V. is rooted in its dominance of the EUV lithography market, with its TWINSCAN and TWINSCAN NXE systems enabling production of cutting-edge AI accelerators like NVIDIA's H100 and AMD's Instinct. This product cycle advantage justifies today's valuation, given the high demand for leading-edge chip production. However, there are risks to consider, including potential delays in customer orders due to global economic uncertainty and the impact of U.S. export controls on sales to China, affecting customers like SMIC. Visual, chart showing the decline in SMIC's chip production due to U.S. export controls. The physical limits of EUV technology and competitive threats from other lithography players also pose a threat. A question that cuts to the core of ASML's prospects is, how will the company navigate the delicate balance between meeting strong demand for EUV machines and managing the risks associated with U.S. export controls and global economic uncertainty? The lab's answer is that ASML's ability to adapt its production and sales strategies to these challenges will be critical, and its success will depend on its ability to maintain its technological lead and diversify its customer base. With an AI score of 53 out of 100, the lab's conviction signal is clear: watch for ASML to break through the $1,399.42 resistance level. B-roll, animated chart showing ASML's stock price movement, with a close-up of the $1,399.42 resistance level. This is the level to beat, and if ASML can surpass it, we may see a significant upside catalyst driven by strong demand for its EUV machines. MRVL is our top signal today. Subscribe, like, and comment below which stock to cover next. Please remember, our analysis is educational, not financial advice, so do your own research, as past performance doesn't guarantee future results. We're here to learn together, so take our insights as a starting point. Thanks for joining us in the lab. We'll see you in the next video.